10 questions you should be prepared for when raising capital. And then really the question behind the question. And I learned this from one of my key mentors, my father-in-law, that generally when someone's asking a question, they're not asking like there's usually a question behind it, right? And so I thought it would be more valuable to tell you the kind of surface level question, and then I think really what the question is. And where I think it's appropriate, I will give you some suggestions and comments and thoughts. But okay, so here's the first one. How much money are you raising? And really the question behind that is, how much risk are you taking on? What's the loan to value? What's the debt coverage ratio on this project? They want to know kind of how much risk you're taking, right? Question number two, how much are you investing in this project? So I'm looking down because I've got my notes here and I just want to make sure I don't miss anything. So the obvious question is like, do you have skin in the game, right? But generally more sophisticated investors are looking for your staying power, right? I mean, if you put in, 50,000 or a nominal amount into the deal, but you're pulling out $100,000 or $200,000 on day one, they know, like they don't have to be told. They know that you're doing this deal and it's probably putting food on the table, right? I'm not saying there's anything wrong with that, but sophisticated investors want to know that you're going to be there, like for the long haul, right? And so if you could be forcing a deal if you're just trying to make money. So just think about that. Number three is, why do you like the property? And here, obviously you want to discuss what it is about the property that you like, but beyond that, I really want to focus on, and maybe not focus is the right word, but what I want to do is I want to share like the good and the bad, right? Because smart investors know that no property is all sunshine and rainbows. Like there are going to be challenges, like nothing is perfect. And so I think it's important that to build credibility, that you don't want to come across as someone that only focuses on like, this is amazing, you can't lose. Like anytime I hear these kind of words are guaranteed, like they're just immediate red flags that this is someone that I will stay away from, because I get pitched quite often too. Question number four is, what is the exit on the property? And this is, to me, this is a bit of a loaded question because and I'll be very candid. Generally, when I'm doing developments, I'm going to have like two off ramps, and I explain both, right? And I'll generally say, look, if in 3 years or 5 years or whatever it is that our typical hold period would be, if the market is soft, I don't want to have to be in a situation where I'm forced to sell. And so I think just having that upfront conversation and then understanding what it is that they're looking for is really important, right? Like, do you need your money out in X amount of time? So those are conversations, right? And I will say that I have different investments and different groups of limited partners that will come in depending on the type of exit that I have. So just kind of keep that in mind. Question five is, who else is in the deal? And this is kind of, this might rub people the wrong way, and it's not meant to, but the reality is, like, if you're, I'll say like a heavy hitter, high net worth, sophisticated money, you generally want to know that you're shoulder to shoulder with other high net worth investors, because if things go wrong, then the group together is going to be there for the duration, right? If you're invested with people that are putting in their last $25,000 or $50,000 into a deal, if a storm hits your project, not literally, but I guess it could, but if things go wrong, and someone's put in their last 25, they can't come up with another 25 in most cases, right? And so that's where generally you see projects fail. So smart investors are going to want to know, like, am I shoulder to shoulder with other sophisticated, smart investors? Okay. Number six is, what are the returns? And usually what a limited partner is looking for here is like, really, like, what's my cash on cash return? Because you can't fake that. An IRR, much easier to manipulate. And I suppose some people will be asking for, like, what's my equity multiple? I mean, there's other metrics, but I would say cash on cash is generally the most important. And then, like, what's the, on exit, what's my IRR or what's my equity multiple? Question seven is, who is part of the GP team? Here, there's a couple of questions that are going on. The first is, how long has this GP team been together? Because if it's a group of general partners that have never done business together, that increases the likelihood of friction and things going wrong, right? So that would be one. And what else? Yeah, I would say that, and then kind of tied to that is, what's the track record of the GP, right? Question 8: what could go wrong? Here, what an investor is asking is, what contingencies have you put into play, and sensitivity analysis are you underwriting to, right? So in reality, there's so many variables that could happen, and it's hard to kind of factor in like COVID, right? I mean, or interest rates like tripling or something to that effect. However, investors do want to know, like, have you thought through this project, and are you taking into consideration, like, what if it takes longer? What happens if it costs more? What happens if interest rates go up? What happens if your cap rate doesn't compress, right? I mean, I would see so many presentations from people over the past couple of years where, like, the only way that the deal actually penciled out, because the cash on cash was skinny and they were focused on equity multiple or IRR, but the only way they were getting those IRRs was based on like cap rate compression, meaning that the exit value was going down because the cap rate got smaller. And the other one was rents going up, right? And oh, by the way, we were going to shrink expenses. So it was like this blue sky that they needed to happen in order for the project to work out. And look, in an up market, you can get away with those type of kind of aggressive assumptions. But I think in today's, like, the reality of where we are today, it is definitely shifting in most markets to a buyer's market where it's harder to raise money. So investors are being a lot more careful on the types of projects that they're putting money into. Okay. Number 9, how are you compensated? So smart limited partners, and I didn't realize this one until one of my limited partners, a very good partner of ours, John. He basically said, like, I want to make sure you're compensated enough so that you see the deal through, right? When I first heard the question, I almost was a little bit defensive, if you will, because I was thinking, like, geez, like he's trying to grind me on how much money I'm making. But he was actually asking the question from the premise of, are you going to make enough money to make it worth your while to work on this for 2, 4, 5, 10, whatever a duration is that your project is going to go on for? They want to make sure that you've got enough compensation. Now, the inverse is, they don't want you to be getting rich off of their taking the risk, if you will. So it is a balancing act, but smart investors really want to make sure that there's enough, but not so much that it's egregious. Okay. And then the last is, what happens if, right? You can fill in the blank. Today, that is, what happens if interest rates go to 10%, 12%, 15%? I'll give you a quick example. I had one of our investors ask me this question, and they asked the question, like, back when interest rates were 2.5%, they said, Shane, what happens if interest rates get to 18%? I said, look, if you think interest rates are going to go to 18%, don't invest in this deal. Like, this deal will fail. I'm personally guaranteeing this loan, and I would never do this project if I thought it was going to 18%. And I said, look, I've run these all the way to X percent. I can't remember what that was, but I think it was maybe 6%. Now it's surpassed that. However, that was kind of the just honest answer, right? Like, if you believe that they're going to go to even 10%, you should not do this investment right now. So I guess just the takeaways, if you will, are, number one, like the harder you sell, the more resistance you're going to get. Generally speaking, when I'm raising capital, it is very conversational. I'm not trying to push someone into a fast decision, and really, like, the more needy you come across, the less likely an investor is going to be willing to give capital to you. So anyways, none of this is like investing advice. This is just some of the experiences I've had. These are 10 questions I hear often, and I thought I would just share it because it might help you if you're in the market and raising capital. So hope that helps. We'll see you next time. Bye.